And the same thing with Bitcoin. When you see more and more coins trade hands at those higher price levels, it helps lower that ratio because basically the cost basis, the average cost basis is catching up to some extent with that wild explosion in market cap. And so what I generally point out is that we've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see.
Lyn Alden explains her thoughts on Bitcoin by emphasizing an awareness of the larger macroeconomic landscape rather than establishing strict price targets. Instead of forecasting precise figures, she looks at things like investor sentiment, central bank policy, and global liquidity to identify potential future directions for Bitcoin. Although the path to $100,000 was always going to be there, she notes that both bulls and bears are frequently taken aback by the timing. Lyn believes that long-term conviction, risk management, and probabilities are more important than hype. She examines the fundamental inefficiencies in the financial system that can cause a significant capital shift into decentralized assets like Bitcoin rather than focusing on chasing short-term gains. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
So far it's in line with my base case, which was that they probably would have ring-fenced their existing holdings. So they have coins from seizures and forfeitures. And so whatever percentage of those coins that are, say, not returned to rightful owners, or legally rightful owners, that they would ring fence that. And that's what the executive order said to do. Basically take those coins and put it into a separate reserve and don't sell them. I think the slight upside of the executive order to do it was that the treasuries authorized to explore budget neutral ways to accumulate Bitcoin a little bit more. I expect that to be kind of low numbers, but maybe I'll be surprised to the upside. And then they also, I think, did a good job of separating out Bitcoin from the rest of the cryptocurrency space, because they put those, again, from like forfeitures and reserves, forfeitures and seizures, they put them into a different bucket and is treated differently, because the Bitcoin one, by executive order, they're not allowed to sell it. Whereas by the same executive order, the Treasury Secretary can use their judgment to figure out what they want to do with other coins, which can include selling them. And I think that's good because generally speaking, you don't want a government picking favorites on assets that are kind of securities or have security-like aspects, like as they're entities with an issuer in many cases. And so rather than choosing different cryptocurrencies, many of which have a long track record of underperforming Bitcoin over multiple cycles, it's kind of just treating that as a separate, less important pool of capital, and instead kind of focusing on Bitcoin. But I think that the majority of the outcome is just going to be no longer them selling it, and we'll see what happens around the margins for further accumulation. I wouldn't bet my long-term bullish thesis on the idea that America is going to go out and buy like 500,000 coins. It would shock the price of the upside if they did. But my general bullish case is kind of assuming that it's roughly flat or flat to mildly up over the next several years.
In your newsletters, have you put any Bitcoin price predictions? Are you staying away from that? I forget if in your latest newsletters you have any price predictions for Bitcoin over the next 6 or 12 months. Are you sharing anything like that right now?
Not particularly. I mean, earlier I said I think
I know it's a wild question.
Yeah. I try to give conservative targets. And for example, I was pretty sure we would hit 100K, and we did. I thought maybe we'd hit it in 2025. It was interesting that we touched it late last year. What I tend to monitor instead is levels of euphoria. So instead of saying, it's going to go to this price by this year, there's a couple of things I look at. One is Bitcoin tends to correlate with liquidity conditions. It generally does better in conditions where liquidity is going up, which is in some ways another way of saying debasement's going up, which is different than just CPI. And then the other one is like when you look at some on-chain characteristics, one of the big ones I look at is market value compared to on-chain average cost basis, because what I'm trying to do is look for the probability of a multi-year correction. Because that's something that obviously readers would want to know about, want to assess the probability of. And historically, whenever that metric goes up really fast, so the market value goes up like 5x or 10x, and a fairly small number of coins cause that big move. Like to put it in real estate terms, if there's like say 20 houses on a street, and like none of them have sold, bought or sold in years, and one of them finally changes hands, and it's 50% higher than its last price. Generally speaking, the value of the whole street now is higher, even though only 5% of the houses, 1 out of 20, have basically now moved the price, the perceived price of all those houses. The same thing happens in a more liquid sense in Bitcoin, which is there's a bull market around the margins. It's tightly held. Some influx of capital comes in. Bitcoin goes up really quickly. But when you look at how many coins actually changed hands, it's usually a pretty small percentage in that initial bull run. And then you kind of like want to see that become more real. So for example, on that house street, you'd want to see another house sell at like a similar price, and maybe a third house before you say, okay, this is probably like something approaching the new price of the street. We can have more confidence in it. And the same thing with Bitcoin. When you see more and more coins trade hands at those higher price levels, it helps lower that ratio, because basically the cost basis, the average cost basis, is catching up to some extent with that wild explosion in market cap. And so what I generally point out is that we've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices.
Mm-hmm.
According to Lyn Alden, gold's recent impressive performance is consistent with its historical function as a hedge against the depreciation of fiat money. She thinks gold's 5-year upward trend is still sustainable, despite a 40% rise over the previous year, especially in light of the overall state of the world economy. Gold's long-term worth is further supported by the persistently high demand from nations like China and India. Alden also emphasizes how stablecoins are becoming more and more crucial to preserving international capital flows. Stablecoins encourage ongoing overseas investment in U.S. treasuries by providing digital access to U.S. dollars outside of the conventional banking system. The current dominance of American assets in international markets is maintained in part by this process. The financial environment may change in the years to come, she says, as there may be a slow transition away from a strong reliance on treasuries and toward more neutral assets like gold and Bitcoin. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
I know you've written about this recently, and I just wanted your take. What are you making on the current level of the gold price right now? Like, what is gold telling you at $3,000 an ounce or so? What is it telling you right now?
So I think, it reflects a lot of the debasement that happened over the past 5+ years. It can take a while to trickle out. When everything was booming, people were more interested to put it in stocks than in gold. But as things eventually kind of slowed down, some of that capital, I think, spilled over more into gold. In addition, there's been a really strong central bank bid for gold over the past several years. Even though the rest of the world, on average, does hold more treasuries nominally than they did 5 or 10 years ago, it's a really slow growing figure. And especially when you look at official holdings, like central bank holdings, it's basically flat to down on treasury holdings over like a pretty sizable timeline, like 10 years. That was really kickstarted by China when they said something, like 11, 12 years ago. They were like, it's no longer interested to rapidly accumulate treasuries. We're going to instead recycle this into Belt and Road Initiative stuff. So that was kind of a catalyst for this. But we have seen central banks continue to accumulate gold. And so there's been that shift around the margins that has been constructive for gold's price. In addition, there's always strong kind of consumer demand out of China and India. And so I think I think the gold price is in a good place. It's always a little concerning when you see something go up like 40% year over year. But I do think that the asset itself, when you look at, say, the 5-year performance, I think it makes a lot of sense. Well, I think stable coins already are proliferating pretty significantly. I do expect that to be up and to the right over the next 5 years or so, which through this administration and into whatever happens next. And I think the issue there is if you look at those two charts you showed, the first one is the U.S. Is the rest of the world reinvesting in treasuries and capital assets, whereas the second one is basically having them invest in manufacturing facilities and put surplus into gold or Bitcoin and other kind of neutral assets. Whereas actually what the stable coins do is they keep the first chart in place. They keep a portion of the world reinvesting in treasuries to the extent that they're successful, and that's where there's a little bit of a conflict potentially.
Got it. So what do you how do you think this plays out then? What are you thinking?
My expectation is that this is probably going to be a very long process, much how the I think the deindustrialization took decades to occur and reach a scale that became like politically among the biggest things, that to the point where the administration would start highly prioritizing it. And I think this is an initial set of first steps to say, okay, we're at least talking about the problem, doing steps to address the problem, and I think that there probably will be fits and starts along the way, and it'll take decades to gradually unwind that and kind of reindustrialize.
Lyn Alden concludes by providing us with a broad overview of the state of the world economy and its significance. According to her, the significant rise in the price of gold is a reflection of longer-term patterns that have been developing over the previous few years. The value of paper currencies gradually declines as governments run significant deficits and central banks generate more money. In periods like these, gold, which has long been employed as a store of value, gains appeal. Lyn also discusses the growing popularity of stablecoins, which are virtual currencies that are typically based on the US dollar. Without using the conventional banking system, these stablecoins give people all around the world access to US dollars and the ability to invest in US assets. This has maintained the dominance of US financial markets by attracting international capital to US treasuries and other American investments. However, she cautions that this arrangement may not be permanent. Lyn thinks there might be a gradual but noticeable move away from a reliance on US assets like stocks and government debt over the coming decades. Small steps toward this change have already been taken, such as China's decision years ago to invest in infrastructure projects through the Belt and Road Initiative rather than continue purchasing U.S. treasuries at a high pace. Central banks have not increased their holdings of U.S. debt in recent years, instead continuing to purchase gold. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.